Today, we maintained our policy interest rate at 5%, and we're also continuing our policy of quantitative tightening. Three main messages this morning. First, monetary policy is working. Total CPI and core inflation have eased further in recent months, and we expect inflation to continue to move closer to our 2% target this year. Second, growth in the economy looks to be picking up. We expect GDP growth to be solid this year and to strengthen further in 2025. And third, as we consider how much longer to hold the policy rate at the current level, we're looking for evidence that the recent further easing in underlying inflation will be sustained. On a trois grands messages ce matin. Premièrement, la politique monétaire fonctionne. L'inflation mesurée par l'IPC global et l'inflation fondamentale ont encore diminué ces derniers mois. L'inflation devrait continuer de se rapprocher à la cible de 2% cette année. Deuxièmement, la croissance de l'économie semble se redresser. On prévoit une croissance solide de PIB cette année et on pense qu'elle va continuer à se renforcer en 2025. Et troisièmement, pour décider combien de temps encore laisser le taux directeur au niveau actuel, on cherche des signes que la récente diminution de l'inflation sous-jacente va durer. So before taking your questions, let me take a moment to discuss how the economy is evolving. We've revised up our outlook for global growth. U.S. economic growth again exceeded our expectations, and while growth is expected to slow later this year, economic activity is stronger than previously forecast. In Canada, growth stalled in the second half of last year, and the economy moved into excess supply. The labor market also cooled from very overheated levels. With employment growing more slowly than the working age population, the unemployment rate has risen gradually over the last year to 6.1% in March. There are some signs that wage pressures are beginning to ease. Economic growth is forecast to strengthen in 2024. Strong population growth is increasing consumer demand, as well as the supply of workers, and spending by households is forecast to recover through the year. Spending by governments also contributes to growth, and U.S. strength supports Canadian exports. Overall, we forecast GDP growth in Canada of 1.5% this year and about 2% in 2025 and 2026. The strengthening economy will gradually absorb excess supply through 2025 and into 2026. CPI inflation eased to 2.8% in February, and price increases are now slowing across most major categories. Inflation rates for durable goods, clothing, food, and services, such as recreation and travel, have all declined. However, shelter cost inflation is still high and remains the biggest contributor to overall inflation. Some other services like restaurant meals also remain persistently high. Looking ahead, we expect core inflation to continue to ease gradually. The more timely three-month rates of core inflation fell below 3% in February, suggesting some downward momentum. But with gasoline prices rising, CPI inflation is likely to remain around 3% in coming months. It's then expected to ease below 2.5% in the second half of this year and reach the 2% target in 2025. As always, there are risks around our forecast. Inflation could be higher if global tensions escalate, and this boosts energy prices and further disrupts international shipping. House prices in Canada could rise faster than expected, and wage growth could remain high relative to productivity. On the downside, economic activity globally and in Canada could be weaker than expected, cooling demand and inflation too much. We don't want to leave monetary policy this restrictive for longer than we need to. But if we lower our policy rate too early or cut too fast, we could jeopardize the progress we've made bringing inflation down. So based on our forecast and these risks, Governing Council decided it was appropriate to maintain the policy rate at 5%. Dans l'ensemble, les données depuis janvier ont renforcé notre conviction que l'inflation va continuer de baisser graduellement, même si la croissance se raffermit. Nos principaux indicateurs de l'inflation pointent maintenant tous dans la bonne direction. Et les données récentes indiquent un redressement de la croissance. La plupart des gens veulent surtout savoir quand on va diminuer notre taux directeur. Qu'est-ce qu'il faut pour nous convaincre de réduire le taux? Pour résumer, les données correspondent à ce qu'on veut voir. Mais on veut voir le mouvement se poursuivre pour être certain que les progrès vers la stabilité de prix vont durer. La nouvelle baisse de l'inflation fondamentale est très récente. On veut être sûr que ce n'est pas juste temporaire. The Governing Council also concluded that overall, the data since January have increased our confidence that inflation will continue to come down gradually, even as economic activity strengthens. Our key indicators of inflation have all moved in the right direction, and recent data point to a pickup in economic growth. Now, I realize that what most Canadians want to know is when are we going to lower our policy rate? What do we need to see to be convinced to cut? The short answer is we are seeing what we need to see, but we need to see it for longer to be confident that the progress towards price stability will be sustained. The further decline we've seen in inflation is very recent. We need to be assured it's not just a temporary dip. In the months ahead, we will be closely watching the evolution of core inflation. And we will remain focused on the balance between demand and supply in the economy, inflation expectations, wage growth, and corporate pricing behavior as indicators of where inflation is headed. To conclude, we've come a long way in the fight against inflation, and recent progress is encouraging. We want to see this progress sustained. And with that summary, the Senior Deputy Governor and I will be very pleased to take your questions.
Okay, thank you, Governor. Let me just quickly go over the ground rules. As usual, we'll start with the reporters we have here in Ottawa at the bank. I'll ask everybody to please limit yourself to one question and maximize our chances of getting to every media outlet. After we go through the room, I will then turn to the phones. If I forget to do so, please state your name and affiliation. Avant de poser une question, veuillez vous identifier si je ne l'ai pas fait. Et comme toujours, libre à vous de poser vos questions dans la langue officielle de votre choix. So let's get started here in Ottawa, and our first question is going to go to Najud Al-Maliz of the Canadian Press.
Morning. Is the door open to a rate cut in June? Is that within the realm of possibilities for you?
Yes, it's within the realm of possibilities. Look, I think we've been pretty clear. We are encouraged by what we've seen since January. If you look at our indicators, they're not all progressing at the same speed, but they've all been moving in the right direction. Inflation's come down, core inflation's come down. The more timely 3-month measures of core inflation suggest there's downward momentum. Yes, shelter price inflation is still high. There are certainly some things that are still supporting inflation, but things are moving in the right direction. We're encouraged by that progress. We need to see that progress continue. And if things evolve broadly in line with the outlook that we published today, we will be becoming more confident that we're clearly on a path to 2% inflation, and it will be appropriate to cut our interest rate.
Okay, next we'll turn to Pramit Mukherjee from Thomson Reuters.
Thank you. Just to continue on Najud's question, I mean, between now and June, you will have two sets of data on the labor market, on CPI, and on GDP. Do you think those data will be, and if it continues in the same direction, do you think that data will be sufficient, will give you sufficient evidence and confidence to actually go ahead for a rate cut in June?
Okay, well, let me expand. Let me take you through a bit more systematically what we've seen since January and what we're looking for in the next several months. So, as I mentioned, if you look across our key indicators of inflation, we have seen progress across those indicators. Some have made more progress than others, but they're all moving in the right direction. So let's just walk through them. The economy in the second half of last year, growth was close to zero. Economy, that allowed supply to catch up with demand. In fact, it's more than caught up. The economy's in excess supply. If you look at businesses' short-term expectations of inflation expectations, they've come down. They're running around 3%. If you look at corporate pricing behavior, it's continuing to normalize. There's a pretty detailed box 3 that looks at this at a very micro data. We also ask companies what they're planning to do, and fewer companies are planning unusually large or frequent price increases. If you look at households, their perceptions of inflation are coming down. Their short-term expectations of inflation have been pretty slow to come down, but they are moving in the right direction. In the labor market, it was very overheated. It has cooled. We're starting to see some evidence that wage growth is easing. If you look at inflation itself, in the last couple of months, it's come down. Core inflation was running around 3.5. It's now just over 3. Again, if you look at the more timely 3-month measures of core, they're now running below the 12-month measures, suggesting there is some downward momentum. If you look at our diffusion indexes, if you look at how broad-based inflation is, it's less widespread. So those things are all moving in the right direction. We're encouraged by this progress, and we want to see that sustained. What is on our mind is that the decline we've seen in momentum is very recent. Wage growth has only just started easing. Inflation expectations for households are only coming down very slowly. So, to summarize, I went through the broad range of indicators to really highlight these are the range of things we're looking at. It's not one data point. It's not one number. It's all this evidence coming together, and the message is, look, we are seeing what we hoped and we need to see. We just need to see it for longer to be confident that we are clearly on a path to 2% inflation. And when we are at that point, it will be appropriate to reduce our interest rate.
Okay, I'm going to go to Jordan Gowling from CTV next, please.
Hi, I just want to ask you a bit about the rebound in business investment in Canada in 2024. What's accounting for that? Do you just see that as a blip, or a beginning of a sustained path of investment and more confidence in the Canadian economy?
Business investment through the second half of last year was really quite weak. If you look at, for example, Statistics Canada's survey of what companies are planning in terms of their CapEx, they are certainly planning more. We do think that's going to take a bit of time to materialize. So through the first half of the year, we don't think it'll be that strong, but we do think it will be picking up. Overall, if you look at our growth profile for this year, if you look at quarter by quarter GDP growth, roughly about 2% in each quarter, that gives you an annual average of 1.5. If you look at it on a per capita basis, what you see is it starts pretty weak, and as you get further into the year, on a per capita basis, it's picking up. So what that means is that, per household, households start to spend more over the course of the year. Companies invest when they're more confident that that investment is going to yield a good return on them. So they want to be assured the demand is there. So over the course of the year, we think that will start to become more apparent.
All right, let's go to Mark Rendell of the Globe and Mail, please.
Thanks for taking my question. The growth forecast for both Q1 of this year and for the full year have been upgraded significantly. It seems like a lot of that is being driven by population growth, but I'm wondering if you can expand a little bit more on what's driving that growth upgrade. how much of it is that population growth picture versus other factors, and if you can kind of unpack a little bit of that.
You're right, Mark, that the main factor is population growth, particularly in the first half of the year. We have revised up our estimate of population growth in the first half of the year. As you get later in the year and into 2025, we've actually revised it down because the government has announced caps on temporary foreign workers, or non-permanent residents, sorry, which will pull it down. But in the near term, it is higher, and so you got more households, more consumers. That adds to demand, that adds to growth. There are some, in the very near term, there are some special factors that are boosting growth. In the first quarter of this year, there was a public sector strike in Quebec at the end of last year. That ended. That will provide kind of a mechanical boost to growth in Q1. There were also a number of other events in the second half of last year, things like the forest fires we all remember. So, just the unwinding of those will boost the first quarter. But you're right, the main thing is working age population is growing faster, there's more consumers, there's more workers. As you get to the second half of the year, population growth starts to slow, but consumption per household starts to pick up. So that when you look at growth on a quarterly basis through the year, we do expect some choppiness in the quarter over the quarters, but if you average them, they average about 2% a quarter.
Thank you for that. Let's go to Greg Quinn from Market News, please.
Good morning. I was wondering about the slight increase to the estimate of the neutral interest rate. Is that any kind of barrier to how fast you can cut interest rates? In other words, is it any kind of a hard floor or a squishy placemat?
Greg, what I would emphasize is that, first of all, the neutral rate is not something we can observe directly, and there's a lot of uncertainty about it. We do estimate it, and it's a necessary input in our models, but it's not something that really has much of influence on real-time monetary policy. I mean, in real time, we're much more focused on where's inflation headed, what do we need to do to get inflation back to the 2% target? What do we need to do to maintain it? I mean, the neutral rate is, it's a theoretical concept. It's you want to think about it. The neutral rate is where our policy rate would be in the long run when inflation's at target, the output gap is closed, and there are no shocks. Well, of course, we'll never actually get there. In your forecast in the future, there's no shocks because you can't forecast shocks. But of course, when we get to the future, there will be shocks. So yes, it's something we need in our models, and in being fully transparent, we publish the core assumptions underlying our models. That's one of them. We revise it once a year, and with our estimate of U.S. Neutral rate going up, and with some other factors, we have revised up our neutral rate by 25 basis points. It's a range. The range moved up 25 basis points. Is that having a very big impact on our deliberations in real time? No.
Okay, let's go to Mackenzie Gray from Global News next, please.
Hi there. In the NPR, the main upside risk sections for inflation, the number one thing, or at least the first bullet point, was house prices could rise sharply. Can you just kind of take us through the assumption on that? And when it comes to deliberations on potential increased interest rate moves, how much consideration is put into what will happen within the housing market?
Well, as you point out, we list it as one of the risks. Certainly, we do expect some pickup in house prices. As long as the demand for housing outstrips supply, there'll always be the potential for upward pressure on housing prices. So we have forecast some increase. What we outline in the risk section is that increase could be more than we anticipate, and if that were to happen, that could put sort of pressure on overall inflation. But what I would stress is, it's one of the things that we take into account when we make a policy decision. It doesn't rest on our decisions don't rest on any one indicator. As the governor's outlined, we think about a lot of things, and we outline more than one risk. So it's there. It's one of the risks. It's not the only one.
Okay, next I'm going to go to Kevin Carmichael from The Logic, please.
This report and much else that we're seeing.
I think you need to put your mic on, Kevin.
It is on. You not hear me?
Oh, project.
You want me to project? Get on my, stand on my chair too. Question about U.S. productivity, the U.S. productivity boom. Those numbers sort of loom over this report. They loom over much of what we're seeing in the global economy right now. What's your read on how real that boom is? There seems to be debate out there whether this is something that's going to be sustained or a passing phase. What's your take?
Look, it's a very tough question. Just to link it into our own monetary policy report first. We did revise up our estimate of U.S. potential. Most of that actually is higher population growth. Some of it is productivity growth, but we have not taken on board a big permanent shift to higher productivity growth. To be honest, I think in all our countries, the gyrations we've seen in the economy through COVID have created big swings in productivity growth. When you shut down your service sector, that's lower productivity than manufacturing. Mechanically, productivity goes up. I mean, where the U.S. stands out is in Canada, like in most countries, productivity growth coming out of the pandemic has been disappointing. We thought we would see more pickup as supply chains got back to normal, as companies brought on board employees and got new employees and got them trained up. So far, we really haven't seen that. In the U.S., productivity went up mechanically in the COVID like everywhere else, and it has stayed higher. There are certainly some things you can point to. You look at the stock market, the large tech companies are doing very well. They tend to be very scalable, very high productivity companies. That might be one reason why U.S. productivity growth has been higher than others. But I think at this point, it's hard to say just how persistent that rise in U.S. productivity growth will be. We have not built in a kind of a big productivity boom in the U.S. in our projection.
Okay, we've got a couple more questions here in the room. Next, I'm going to call on Paul Vieira of the Wall Street Journal, please.
Was there any talk among officials about cutting rates today?
Paul, we did discuss when to reduce our policy interest rate. There was a clear consensus to hold the policy rate at 5%. As I've indicated, we were encouraged by the progress we've seen since January, and we agreed that what we wanted to see this progress sustained. We wanted more time to be confident that this progress would be durable. We also agreed it would be appropriate to cut the policy interest rate when we're confident that we're clearly on a path to the 2% inflation target. Now, as you might expect, we're a council of 6 different people, and so there is some diversity of views about how close we are, and when we're going to see what we're looking for. I would just say, I think that's why you have a council. You want some diversity of views. That's healthy, and we're having a good discussion. For the decision today, there was a clear consensus to hold at 5%.
Okay, and I'm going to go.
And you will be getting the summary of deliberations in a couple of weeks where we will expand.
Sorry about that, Governor. We'll go now to Randy Dong Knight from Bloomberg, please.
How worried are you about relatively weaker loonie restocking inflationary pressures?
Look, we have a flexible exchange rate in Canada that allows us to gear monetary policy to what's going on in Canada. And overall, the Canadian dollar's been really reasonably stable. If the Canadian dollar does move, that's something we'll take into account in terms of our outlook. It will affect, a weaker Canadian dollar will tend to make our exports more competitive. We'll tend to have more strength in exports. There will be some direct pass-through through imported goods. Those are things we take into account. But look, the flexible exchange rate, it's what allows us to run a monetary policy in Canada geared to what we need in Canada, and we will be, we're gearing our monetary policy to where we think inflation's headed in Canada.
Okay, we're going to go to the reporters who have joined remotely now. I'll just remind you on the line to come off mute only to ask your question, and then please go back on mute as soon as you finish so that everybody can hear the response. I'm going to start with John Ehrlichman from BNN Bloomberg, and then go to Alicia Sikierska from Yahoo and Max Sato of Mace News. So John, first question to you, please.
Thanks so much. And Governor, on commodity prices, which we're watching very closely right now, can you just give us your current assessment on what you're going to be watching on the inflationary front from that perspective?
Well, I guess a couple things on commodity prices. One, you have to look at commodity prices through two lenses. Certainly, global oil prices have a very direct impact on things like gasoline prices, and that has a very direct and immediate impact on total CPI inflation. Gas prices, tend to go up and down, so that's one reason why we're particularly focused on core inflation. And if you look at the near term, we know gasoline prices have gone up. That's why we think total CPI inflation is likely to stay around 3% in months ahead. What we're going to be particularly focused on is core inflation. We do think there will be further gradual easing in core inflation. And when we talk about the progress we've seen recently being sustained, that's what we mean. Or certainly that's an important element of what we're looking for. The other element of commodity prices, of course, is Canada is an important commodity producer. We export a lot of commodities to the world. So the higher commodity prices, the more income tends to come into Canada. So it also affects demand. So we're looking at both those dimensions.
Okay, the next question is Alicia Sikierska from Yahoo Finance, please.
Thanks, Governor, for taking our questions. Given that there will be a new federal budget before the next rate decision, we've already seen some new spending measures announced. Can you talk about how the bank will be evaluating the potential effect of those measures at the next meeting?
Yes. Look, the first thing I have to underline this every time I get a question on fiscal policy. Fiscal policy is appropriately the responsibility of elected governments, not the Bank of Canada. Our elected politicians have a difficult job. They've got many choices to make. But it's not our choice. It's not our job. What we do is we take the spending plans of governments as given. So when provincial or federal governments table a budget, we build those into our own forecasts. So since January, as you've seen, there have been a number of provincial budgets. We have built their spending plans into the outlook we published today. Obviously, the federal budget is a week from now, so we don't have the budget. We have not included changes in the federal spending plans in this outlook. Once the budget is tabled, we will be producing, when we get to, I guess, July, we'll have a new forecast, and it will include the implications of the federal spending plans in that budget.
Thank you for that. We're now going to go to Max Sato from Mace News, please.
Thank you, Governor. Earlier, we saw reports from Asia that semiconductor shortages have been largely resolved, but since global chip demand is recovering and we're seeing slower deliveries of cars and trucks, for example, and shipping companies are also diverting the routes to bypass some areas. So do you think this can be a sign that the global supply chain is not fully recovering from the impact of the pandemic and geopolitical events, and therefore adding upward pressures to prices in general?
Well, if you look in the section that describes the risks to our outlook, geopolitical tensions are one of those things, and the types of things that we're looking at are the things that you mentioned. Certainly, if there's further disruption to shipping lanes, or if some of the global tensions that we see now escalate, that could have an impact both on supply chains and on commodity prices. So it's definitely one of the risks. It's listed alongside housing prices that we were just asked about a few minutes ago.
Okay, our next group of online questions will come from Barbara Schechter of the Financial Post, followed by Anna Pereira of the Toronto Star, and then Rob McClister from Mortgage Logic News. Barbara, please, your question.
Sorry, just coming off mute. I wanted to follow up on the diversity of views that you mentioned earlier in response to Paul's question, I think. I know you don't want to get ahead of your summary of deliberations, but that was raised in the last one. So I just wanted to ask if you could elaborate a little bit on where that is. Is it on in terms of the evidence needed for a cut? Is it on particular data or breadth of data, or would it be more on the risk side, the risk to your forecast?
Well, I think, Barbara, it's all of those things. And I think, I guess, the way I would put it is, all the members of the council are looking at all of those things. We've got different expertise, different experiences around that table. That means people tend to weight different things slightly differently. So I think it's hard to be much more precise. I don't know if you can. You were sitting at the table with me. Anything to add from your perspective?
Yeah, there's 6 of us. It would be really unusual if we all showed up with exactly the same view. We all look at the same data, but as the governor said, our background, our perspective leads us to sort of weight the data a bit differently, sometimes interpret it a bit differently. But that's a good thing. I mean, as the governor said, we have a council for a reason. The diversity of views it's a feature, not a bug. And so, it forces us to have a really robust conversation and I think get to the best possible decisions. So it's always been there. You get to see it more now because we give you a summary of deliberations, but a diversity of views is not a new feature on the governing council. Like I said, there's a group of us and we all come with just a slightly different view, so.
Okay, Anna Pereira from the Toronto Star. If you have a question, please come off mute.
Thanks so much for taking our questions today. I want to know, how are you evaluating the impacts of the policy interest rate on shelter inflation and its effect on overall CPI?
Well, first of all, shelter inflation is high. It's the biggest contributor to overall inflation. Shelter inflation, 6.5%. And that really reflects 2 big pieces. One is mortgage interest costs, which is directly related to the fact that we've raised our policy rates, and that has had the impact of raising mortgages. That's how monetary policy works. And then the second element that is particularly elevated is rent. Rent is, in February, increasing at a pace of 8%. So how does that factor in? There are some other bits of shelter too, insurance costs, repair costs, things like that. How does that factor into monetary policy? Well, I'd underline two things. First of all, our target is for total CPI inflation. That includes shelter, and that reflects the fact that look, shelter's a real cost for Canadians. It's a very important element of their cost of living. So when you're targeting 2% inflation, that's not something you can ignore. Having said that, we know that our policy actions directly affect mortgage interest costs, and we know that when it becomes appropriate to reduce the policy interest rate, those mortgage interest costs will start to come down. So we know, that is something we can control for as we think about our monetary policy response. I've emphasized that we're particularly focused on core inflation. And one of the things our measures of core inflation have been doing is that if you look at the trimmed mean measure of core, it has been systematically kicking out mortgage interest costs through this whole rate increasing cycle. It has not typically been kicking out other elements like rent or other elements of housing. And that's largely appropriate. I mean, the increases we're seeing in rent suggests the real tightness we're seeing in the housing market. That's part of the economy. We have to factor that in. It's not the only part of the economy. We have to factor it in with all the other parts, but it's not something you want to ignore. It's not something you want to look through. By focusing on core, we are effectively, though, looking through mortgage interest costs while keeping, including the other elements of housing, which reflect there is a structural tightness in our housing market. Supply of housing has not been able to keep up with demand. That's probably going to, we're probably going to be living that. We're probably going to be living with that for a while. Certainly, there's a lot more focus now on getting supply up. You've seen governments at all levels are much more focused on this. But it is going to take some time to work through that. That will continue to contribute to inflation.
Okay, Rob McClister, if you're there, please come off mute and ask your question.
Good morning. Canadian inflation tends to be highly correlated with U.S. inflation. The latest readings show U.S. inflation running about 70 basis points higher than Canadian inflation and rising. So could such a divergence continue for a long time? And if U.S. inflation continues shooting higher relative to Canada, should Canadian borrowers expect that the bank would be materially less likely to cut rates this year?
Well, look, the latest U.S. CPI number just came out this morning. We haven't had a chance to look at it in any detail. So, I'm not going to comment on, today's data release out of the U.S. I think, with respect to Canada, look, we're focused on where we think inflation in Canada is headed. And I think I've been pretty clear. Inflation's still too high. As Carolyn has underlined, there are a number of risks. Risks remain. But we are encouraged by the evidence we've seen recently that inflation has moved down. There is some downward momentum going forward. We're looking for that to be sustained. Yes, developments in the United States have an impact on Canada, both the strength of the U.S. economy, and we import particularly goods from the U.S., so that will spill into Canada. If you look at the composition of U.S. inflation, goods price inflation is not the issue. It's more service price inflation, which is not something we tend to impact as much into Canada. So I don't see a big direct imported inflation effect. But look, we'll have to look at this more closely. But I do want to emphasize we have our own monetary policy in Canada. We have our own currency that allows us to have our own monetary policy, and we're really geared towards what's happening inflation in Canada, and that's really what we're focused on from a monetary policy perspective.
Okay, just to wrap up, I believe Pete Evans of CBC had indicated he wanted to join the call and ask a question, but I don't know if he's there. Pete, if you can come off mute by the time I finish this sentence, then you can have a question. Otherwise, that will conclude today's press conference. Thank you, Governor and Senior Deputy Governor, and all of you for joining us today.
Thank you very much.